lots of mudslinging going on over the COMEX. So the most important near-term number I suspect that you want to keep an eye on is the topside trend line, which was drawn down from the August 2013 high, which is the beginning of your falling wedge. And that's sitting somewhere between 1240 and 1250.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit futuremoneytrends.com/gold.
Hello, everyone, and welcome into CrushTheStreet.com. My name's Kenneth Amaduri, and today we're joined with a new guest. She has a 14-year career with the New York City investment banking industry. She began investing in precious metals in 1999 while following the market trends post the dot-com bubble and 9/11. She left the banking industry in 2009 after 5 years in global risk management at Citigroup. She's also a technical trader with a lot to share with us today. She's an educator, and she teaches people about trading, the economy, precious metals, and more. Her name is Trader Steph. Trader Steph, thanks for joining me today.
Hey, thanks for having me. Glad to be here.
Well, I'm looking forward to an excellent conversation. We got a lot to talk about, but let's start off with stocks. You're a technical trader. You've been looking at the stock markets. What are you anticipating right now? There's a lot of volatility out there. What are we looking at these current times, and are you seeing any potential surprises that can hit us in the near future?
I don't follow the Dow and the S&P as closely as I do gold and silver, but I do publish some of the long-term chart patterns and the Fibonacci levels from time to time. And both the Dow and the S&P were popping out and rising wedge patterns. We're talking way back in March. So we've been floating around up there for several months now. And as far as the Dow, there was a 23.6% Fibonacci level, which is sitting at 15,547. And we did have a correction, which went down to 15,381, which was the low in August, where it nailed the 50 exponential moving average on the monthly, and it went just below the 200 EMA on the weekly. So now on both charts, whether the S&P or the Dow, we've got two highs that we can draw a topside trend line. And that's the number that you want to be watching. If that, if the price is going to get lower as time goes forward because the trend line is trending down. Once we take out that trend line, and it would have to be decisively, so you need to see some good volume and a very strong pop, then we'll retest the highs. But if we hit that trend line, which was this month's high, and we don't do anything, I think we're going to trend down lower. And with so many things going on in the world right now, geopolitically, anything's on the table.
So as far as the Fibonacci point, can you exactly give us a little more of an idea of where those points are? And I know you said we need to either go above that, or if it keeps going down, we're in from some further moves. Do you see those further moves being pretty substantial in the future?
Well, looking at the Dow chart, I mentioned the 23.6 Fibonacci at 15,547. And the next level below that would be the 38.2, which is at 13,812. Now, anyone who's out there who's a technical trader who follows trading, Fibonacci levels are very important because they tend to be areas of support and resistance. And Fibonacci levels are like the math of the universe. Everything just seems to flow around Fibonacci levels. If you want to do some research, I suggest Google Fibonacci and you'll get all the information you need.
Trader Steph, let's talk about gold. What are your charts currently telling you about precious metals at the moment? Gold, what is it telling you about gold? And then what's it telling you about silver? Or are they both doing about the same thing at the moment?
Sure. Well, given the confluence of events and the supply-demand fundamentals, geopolitical issues, monetary policy across the globe, it should rise. I'm not in the business of predicting. I do fusion analysis. So if we look at silver, it's in a long-term falling wedge, and that's been going on since the April 2011 high and the September low. But most important number, I think, for traders to be watching is the January 2008 high, and that was $21.34. Now, that's where in 2010, if you draw a lateral line from that 2008 high, that was the breakout point from where we rocketed up to 49.78, the high in April of 2011. And also note that the lower trend line drawn from the September 2001 low, which was $4, has not been broken. And that trend line is sitting right around $13. Now with gold, the gold chart is completely different. You got a February 1996 high of $417.90. And that was taken out in November of 2004. And then it was retested, and that lateral and proceeded upward from that point. And it has broken all the lower trend lines that you could draw. But on a different note, it's developed its own shallow falling wedge. But that didn't start until after August of 2013 high and the June 2013 low. So if we take the 50% Fibonacci from the low all the way up to the high, that number is $1,086, and I consider that to be a pigsty. Lots of mudslinging going on over the COMEX. So the most important near-term number I suspect that you want to keep an eye on is the top-side trend line, which was drawn down from the August 2013 high, which is the beginning of your falling wedge. And that's sitting somewhere between 1240 and 1250.
Okay.
Then after that, you've got the 38.2 fib, which will be 1283. Now, I want to add to this is that I don't know how many traders will be listening to this, whether you're scalpers or you're swingers or you're holding core positions, but you really have to be a Jack, be nimble, Jack, be quick in this environment. And as Carly Garner mentioned, bottoms can be really messy. And if I mention Jesse Livermore, secular markets are typically driven by large-scale national and worldwide events, which occur in combination. And a secular bull market will have a bear market periods within it, but it will not reverse the overall trend. So Jesse once said, it was never my thinking that made big money for me. It was always my sitting. So you need to get right and sit tight, but you need to be nimble if you're out there scalping and swinging short term.
Well, that's definitely the truth, and I think a lot of us really felt that September, October was the moment that precious metals were going to break out, and we saw what is turning out to be maybe a false rally or just maybe just the start of the bull market. Who knows what it'll end up doing? But it's definitely been messy, to say the least. So you talked about some of the technical things. Let's talk about some of the fundamentals. And some of the fundamentals that people are looking at is something you mentioned was the COMEX. And last Saturday you tweeted a Zero Hedge article saying that 38% of all COMEX gold in Hong Kong was withdrawn, which is equal to all of JP Morgan's warehouse in the U.S. What do you think this significance of this is regarding the supply demand and the prices worldwide?
Well, the bottom line is that gold is moving from west to east. And anyone who's following this market is well aware of what's happening. And the majority of the gold is being melted down in Switzerland refineries, which have been running 24/7 for a couple of years now just to keep up with the demand. And they're taking the good delivery bars and melting them down to kilo bars at a higher purity. So demand withdrawals in Shanghai, China alone, we're not even talking Hong Kong or anyone else on the globe, is breaking the previous record set in 2013 and 2014. And wealth investor demand is ramping up. So what we have is an event where the gold is actually moving from weak hands into stronger. And we've got a 300-to-1 ratio of paper versus the registered gold at the COMEX, which is available for delivery. So with that in mind, let's consider what Kyle Bass from Heyman Capital Management mentioned with regard to taking delivery of the physical for the University of Texas. He said, quote, the COMEX had about $80 billion of open interest between futures and futures options. And in the warehouse, they had $2.7 billion of deliverables. So $80 billion in open interest, $2.7 billion in deliverables. We're going to go own it a long time, and that's an easy one. You're just going to go get it. So when I talked to the head of deliveries and said, what if like 4% of the people want delivery? He said, Kyle, that never happened.
So, Trader Steph, I wanted to ask you what your thoughts are on the stock market and if we could see a major stock market crash. We've interviewed some guests who've made some pretty substantial predictions, some as much as 50% correction or crash, or even a 70% in the upcoming years. So, what are your thoughts on this?
Absolutely. Anything can happen in a heartbeat, as we've all witnessed in the markets over the last several years. In a market that's 85% dominated by electronic high-frequency trading and algorithms and unlimited free money from QE for the banks, which, by the way, is still being reinvested. Its QE has never actually ended. And we've got $1.5 quadrillion in derivatives, with a huge chunk tied to interest rates and corporate stock buybacks, which are propping up stock prices. We have a perfect storm that's brewing in this market. And when you're looking at the charts and you see how they're topping over, it's a real dangerous place right now. Short of the Fed coming out starting QE4.
So, Trader Steph, if you were at the head of the Federal Reserve, what would your actions be that you would think is the best for the United States economy?
Well, it's not a problem of the Federal Reserve. It's not a problem they can solve. Now, that's not saying that they haven't contributed to this. They've been one of the primary drivers since 1913.
Right.
But what they've stated consistently is that they cannot solve it. And Jim Rickards has pointed out that there must be some structural reform in economic policy out of Washington, D.C. in order to stimulate growth. Now, that will change the picture. So, in my humble opinion, a few places to start would be bring manufacturing and production back to the United States. Reform the tax code by simplifying it. Give zero capital gains across the board for a period of time.
Zero capital gains. What did you mean by that?
Well, there's a capital gains tax when
Right.
we fill out your taxes.
Right.
Well, make zero for a period of time, so no one pays capital gains.
Oh, okay, no one pays capital gains taxes. That was, okay.
And then repeal Obamacare and get back to a free market healthcare system. I think those 4 points would be a start.
Yeah, no, and it sounds like you've thought about being president.
No, thank you.
Okay. Well, yeah, so do you expect there to be a rate hike up here in December? There's a lot of issues. Obviously, so many rabbit holes. We probably could talk 30 minutes on what could happen on that. But do you expect them to raise interest rates or stay where they're at or even go negative?
Expectations are always funny. I've learned not to expect. But I don't believe that there will be a rate hike. But if there is, I suspect it would be to save face so as not to lose confidence from the markets, which I kind of think that they've already lost some confidence. So they're stuck. They keep saying it'll be based on data. Well, the data doesn't say so. You got the jobs participation with 90-plus million people out of the workforce. Most jobs that are being created are in service-related areas. They're not producing anything like manufacturing does. You have a core inflation, which is a farce. You have a 2% target that's not being met. So you've got deflation. GDP is a mess with a debt in the areas of 100% GDP. Not to mention the interest on the debt will continue to rise and exponentially if they start raising interest rates. So I call this the paper taper. QE never ended, you know. In 2014, the FOMC staff examined the possibility of beginning what they called an exit strategy. And they wanted to unwind their portfolio of treasuries and mortgage-backed securities. And that's not happening. And then at the June 2015 meeting, the Fed decided to continue to reinvest the maturing proceeds back into the Treasury and the MBS market, which they're doing. So we're at these huge levels. Now, this all goes back to monetary policy that's been going on in Maynard Keynes. And one of the things that the Fed is doing right now is pushing on a string. So the problem is, when the problem is inflation, pushing up interest rates, otherwise known as pulling on a string, is a very effective policy tool. Ask anyone who lived through the Volcker years in the 1980s, which, by the way, went straight very fast. Gold went up with it. Mm-hmm. But when rates are pushed down, when you're pushing on a string to try and stimulate economic activity, the push becomes less and less effective the closer you get to zero interest rates. So the inability of the Federal Reserve to get banks to loan and consumers to spend through monetary policy alone, as the cash reserves at the Federal Reserve banks show, and the velocity of money collapsing to 1930s depression levels, and there's no sufficient demand in the economy to get it moving. I don't know what they're going to do, but I don't think raising interest rates is going to be the answer. I think fiscal policy in the United States can get the economy going. People need jobs.
Yeah, I mean, it could be said that they're just too far gone with what they've already done. And everyone in power at the moment, they're just trying to kick the can down the road to at least get through their term, right? Like, look at Obama now with the debt ceiling. He's got enough money to spend to at least get him out of the office, so he doesn't have to deal with that anymore under his watch. So, Steph, let's get back over to gold and silver. And when I look at the gold to silver ratio, historically we've seen it around 16 to 1, and it's had great volatility even over the last 100 years. It hasn't always been 16 to 1, but that's where it's historically been. And right now we're roughly at 76. So let's talk about, are you in favor of silver at the moment over gold, or what are your thoughts when it comes to the gold-silver ratio?
All right. Well, I have no idea what could happen in, let's say, 5 years. And the ratio is based on what's in the ground. And some industry experts are actually saying that it's probably now it's as low as 10 to 1. So the price ratio is going to do what it wants to do as the price movements take place. And I don't think that silver is undervalued because of a price ratio. You know, it's undervalued because the price, just like in gold, is being managed, suppressed, and manipulated. The evidence is out there if you just research it. So just as all the market sectors have become manipulated, whether it be LIBOR, Forex, currency markets, bond markets, but as far as a return, I would favor silver because generally the move, it's a monetary metal, just like gold, and silver is the little brother. And when you get a move in silver, it's going to be a couple percent higher, whether it would be down or to the upside. So your investment return is going to be much higher with silver because you can actually purchase more.
Steve over at SRS Rockwell Report, Steve St. Angelo, he does a lot of excellent research. And he shows that in 2014, the U.S. and Canadian silver production was 53.4 million ounces, yet consumption from minting silver eagles and maples alone was 73.2 million ounces. Have you done any research, or what are your thoughts on this supply-demand imbalance and how long it can go on for?
Well, look, as long as the paper game continues, you know, we could wait for a currency event, which we've already got currency wars. It could be a geopolitical event. You know, we currently got the game going on over in Syria, which has turned into a big mess after the Paris attacks. Or there could be a force majeure on one of the major exchanges. So, all the major mints across the globe, which this has never happened before, they're all allocating, or what they're actually doing is they're rationing silver. And when we look on the side of the mining industry, particularly in gold, they're high grading. The big mines are high grading their open pits, which means they're taking off the supply off the top, which has the most gold in it first, in order to make up the difference because of the cost of production due to the price fall. So the mining industry is basically in trouble across the board. And then we've got China, which is using its sovereign wealth fund, known as the China Investment Corporation, and they've been purchasing mining assets across the globe. So they don't necessarily have to be taking supply off the known usual channels on the globe. And if anybody wants to look into that, look, this started way back in 2005, 6, and 7, and there was a book published called China Safari, on the trail of Beijing's expansion into Africa. It was published in 2009. So there's definitely a divergence between what's really going on in the physical market, whether you're talking about gold or silver, and what's going on in the paper market. And it's going to have to resolve itself. Fundamentals always win. It may not happen when you want it to happen, but you just have to be patient and pay attention to what's happening in the market.
It's really going to take a big buyer to come in and bust the COMEX to demand delivery of all of those ounces. But the reality is the big buyers, they just deal in the paper, because to deal with thousands and hundreds and thousands of ounces of silver is kind of overwhelming for just someone who has a lot of money. They don't deal with physical ounces. They deal with the paper market. So yeah, I don't know how long this thing can last, and I listen to a lot of people who make these predictions, and I think it's very fascinating, and I know that it can't go on forever. So my bets are in that direction. So Trader Steph, I wanted to give you an opportunity to share any last thoughts, and also let everyone know where they can reach out to you and follow you.
If everyone would like to give me a follow over at Trader Steph on Twitter, that would be awesome. If anything I could leave you with is focus on fusion analysis. Technical trading is great. Looking at the fundamentals are great. But when you get into a situation that we're in right now in the world, and you're looking at the fundamentals and the charts are not making any sense to you, you can't be discouraged. Really have to take note of what's going on and put all the pieces of the puzzle together. And don't be looking for predictions and dates and prophecies. You just really need to keep your head about you, keep your emotions in check. And what it's about is how many ounces do you have, not how much money you're making, because what you want to do is preserve your wealth.
Trader Steph, yeah, it really is amazing out there. There's so much information, and you can get overwhelmed by looking at all the news articles, and I do myself, because I spend a lot of time researching and trying to understand. And what I've come to find is that it takes a prudent attitude. It takes just, sometimes you have to ignore some things to make sure that you're doing the right thing and you're being prudent with your money. So that's great advice. Thanks so much for taking the time to come on the show with me today, and hopefully we'll do it again soon in the next few months.
Oh, thank you so much for having me. It's been great.